Welcome everyone to today's program. I am Mary Rectoris with Becker's Healthcare. The program will begin with a presentation, and we will have a question and answer session following completion of the presentation. You can submit any questions you have throughout the presentation by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our presenter will attempt to answer as many questions as he can during this time. You will receive an email within about a week following the webinar that will include instructions for how you can download a copy of the presentation. You will also receive a follow-up email shortly after completion of the program. You can submit your feedback or any additional questions at that time. This email will not include the presentation. It is my pleasure to introduce today's speaker. Mr. Janiga is a partner with Healthcare Appraisers and for the past 10 years has been providing his clients consultation, healthcare business valuation, litigation support, intellectual property, healthcare provider compensation relationships, and other types of financial analyses. Mr. Janiga's extensive industry experience includes working with healthcare organizations, attorneys, administrators, providers, developers, consultants, investment bankers, and private equity groups in connection with transactions involving ambulatory surgery centers, cancer centers, diagnostic imaging centers, dialysis centers, lithotripsy companies, physical therapy centers, pathology laboratories, urgent care centers, physician practices, hospitals, hospital departments, medical device manufacturers, durable medical equipment suppliers, patent holding companies, accountable care organizations, and other healthcare entities. Many of the transactions that Mr. Janiga analyzes involve Stark, anti-kickback, IRC 501, and/or other regulatory implications, which necessitates analyses of fair market value and commercial reasonableness. Mr. Janiga earned a Bachelor of Business Administration degree in 2007 from the Seidman College of Business at Grand Valley State University, dual majoring in finance and economics and minoring in accounting. He is an accredited senior appraiser in business evaluation through the American Society of Appraisers. It is now my pleasure to turn the floor over to Mr. Janiga to begin today's presentation.
Thank you, Mary. I appreciate the introduction, and thank you everyone on the line for participating in the webinar today. So just scrolling through, I'll give you a quick outline of the presentation and the valuation considerations in ASC joint ventures. So the recent experience by healthcare appraisers here, we've seen a lot of supply and demand factors driving additional joint venture activity in the space that maybe we wouldn't have seen several years ago. Some of these factors are macro factors that are impacting the industry as a whole, and some are more micro factors that are impacting the very specific geography the centers are within. We're going to talk a little bit about forms and structures of recent joint venture activity. Give you a couple examples of HOPD joint venture activity and some of the things that are driving those joint ventures. We're also going to go through a quick valuation overview and fair market value considerations. And then lastly, we're going to discuss common errors and pitfalls in these sorts of FMV analyses that involve joint ventures. So in looking at the macro supply and demand factors, we're going to start off with where we've been the past decade and some of the recent regulations that have impacted the industry, some of them impacting surgery centers more than others. So the Deficit Reduction Act back in 2005 impacted more imaging centers, but there still is an impact on HOPDs as a whole. I think really led to some of the further regulation that we see here. In 2006, we see an increased competition when physicians were allowed to start constructing physician-owned hospitals again. There was the end of the moratorium. 2010, we have the Patient Protection and Affordable Care Act that impacted the industry as a whole quite vastly. 2011, we had the Budget Control Act. This impacted reimbursement industry-wide in 2013 with sequestration. We get into 2012 with the American Taxpayer Relief Act. That didn't necessarily impact surgery centers quite as much. But then in 2013, there was a MedPAC advisory report issued to Congress that talked about the complications and issues that the industry is facing with payment differentials across ambulatory settings, really highlighting differences in payment among freestanding ASCs and HOPD surgery centers, and specifically calling out surgeries that are tend to have less complications, tend to not be as emergent, outlined ophthalmology cases and pain management cases specifically. And then in 2015, we saw in the Bipartisan Budget Act, specifically Section 603, we saw an aspect of site neutrality being brought into the industry. For site neutrality, it doesn't impact HOPDs that are already in place as of the enactment date, but really impacts go forward operations. And for the fact that going forward, there is going to be payment neutrality across the site. So if a hospital goes ahead and buys a freestanding ambulatory surgery center, they're not going to be able to change the fee structure to be able to bill and collect at higher rates under the OPPS schedule. And then kind of continuing with that, something that's in the future that I think impacts the industry as a whole and will impact surgery centers. The Department of HHS anticipates shifting a large percentage of Medicare fee-for-service payments to alternative payment mechanisms, looking for value instead of volume. That's certainly a situation where we need lower cost settings for care when appropriate, and I think site neutrality is an important aspect of that. Again, staying with macro supply and demand factors, taking a look at population health management, value and risk-based contracting with payers, looking at Medicare, shared savings programs, and other ACOs. We're going to need more joint venture ASCs in the industry to be able to continue to make sure that ACOs are successful, to continue to make sure that spending doesn't spiral out of control. If surgery centers all became HOPDs, we'd certainly have problems with the system more so than we already have. Here, looking at the macro supply and demand factors, we can see here HOPD Medicare rates as a percentage of ASC Medicare rates by year. You can see ASCs have been receiving quite a bit less reimbursement than HOPDs over the last several years here, and that gap has only been expanding since 2008. In 2008, HOPDs were receiving 158% of what an ASC would receive for the same Medicare procedure, whereas in 2016, now it's at 179%. The next several slides outline hospital employment across various surgical specialties as well as family medicine or primary care physicians, being that they tend to refer quite a few patients to these specialists. And some of this may have some survey bias based on specifically here MGMA and the customers that they were surveying and trying to get to participate in their different survey products. Nonetheless, it shows a pretty significant trend of hospital employment across specialties. We also see GI physicians here increasing from 9% to 43% over the 11-year period. We see pain management increasing to 47% over the 11-year period. Urologists increasing from 5% to 46% over the period. Ophthalmologists from 8% to 41%. And ENTs increasing from 13% to 45%. Those particular surgical specialties that I selected tend to refer quite a few cases to ambulatory surgery centers, I thought those would be most appropriate to review for the presentation here. For family medicine, the percentage of primary care physicians employed by health systems has increased quite substantially from 48% to 76%. Again, this is another reason why we're seeing additional joint venture activity. There are less independent family physicians out there referring cases to independent orthopods. They tend to be part of larger medical groups or part of integrated systems. So some of the supply of cases are being shifted towards these hospitals. So hospitals are looking at how they can continue to align with independent orthopods in their respective communities. Here, taking a look at really a maturing market. It shouldn't be too much of a surprise to anybody on the line here. In 2000, we had about 3,000 Medicare certified ASCs. Out in 2014, we have just under 5,500 Medicare certified ASCs. You can see that from a growth standpoint, we've seen quite a bit of leveling off since roughly 2008, 2009 time period. With a maturing market, you're going to see different strategies enter the marketplace. So we're seeing more creative joint venture alignment options being considered, which I suspect will possibly see this number stay stagnant or continue to grow at a much more nominal rate. And we'll talk a little bit about what else plays into the Medicare certified ASCs here in a second. But looking at some of the more micro supply and demand factors, getting into the particular areas where we're seeing these joint ventures take place, the size of the primary service area has a large impact. If we're looking at a rural area versus a more urban or metropolitan area. In some of these rural areas, it may be the only freestanding ambulatory surgery center in the market. There may be more of an appetite to work together and joint venture. It may be one small health system, one small hospital that's part of a larger health system that's in that market, and they may not be in a position to purchase the whole ASC and also acquire the associated medical group or medical groups that refer cases to the ASC. So we're seeing a lot of joint venture activity in those markets. In some cases, they're also bringing in ASC management companies to help assist and be a third partner in the joint venture. But looking at the number of existing market participants in a local geography is important as well. There's several markets where you may have just one or two market participants, or others you may have 4 or 5 or even 6 market participants. A few of the areas they may be in, hospitals and health systems being a large market participant, as well as ASC management companies. You already have existing freestanding ambulatory surgery centers, and then you have your independent physician groups and surgeons that are in the marketplace. You see state-specific items, certain states requiring certificates of need. You have certain aspects with reimbursement. Up in Alaska, a good example is some changes that have occurred recently to workers' compensation reimbursement. It declined substantially in 2016 relative to 2015. And you also see other physician employment trends that are more state-specific. If you have corporate practice of medicine restrictions, you may see synthetic employment arrangements and other sorts of creative alignment opportunities, which could ultimately impact the way a surgery center is run and whether it's joint ventured or not. But then you always have the local economic and demographic conditions. The economic condition in, say, Denver, Colorado versus another market such as Flint, Michigan. There's going to be drastically different economics and demographics that are occurring in each market that are going to change the performance of the surgery center, change whether a joint venture makes sense, and several other factors. In looking at forms and structures of some of the recent joint venture activity that we've been involved in here at Healthcare Appraisers, always getting involved in de novo surgery center opportunities. Some of these de novo surgery centers have been established, say orthopedic group or some other surgery group that say is looking to change its partner. Maybe it's selling out in a larger multi-specialty surgery center it has an ownership interest in. They're having a hard time obtaining the surgery blocks that they want, and they're looking for maybe more of a single specialty or a surgery center that maybe caters to some of the individual surgeon's needs a little bit more. So maybe they're changing out partners, maybe they're divesting an interest they have in a current surgery center and looking at starting up a new surgery center with another existing partner in the marketplace. Have existing surgery centers themselves trading hands, looking at HOPDs being contributed to new entities, and we'll talk a little bit about that in another slide here. And then also freestanding surgery centers being contributed to a new joint venture entity whereby possibly there's some consolidation in a marketplace that involves multiple freestanding surgery centers and wanting to joint venture those freestanding surgery centers with a larger group. You have some existing surgery centers as part of a larger joint operating agreement. Here you may have some health systems that are looking to align themselves and work together across a particular service line, say musculoskeletal service line. It's going to involve more than just surgery centers themselves. It's going to also involve inpatient care and other aspects of follow-up care, being physical therapy and the like. If single and multi-specialty surgery centers, like I said earlier, there may be reason for looking at a single specialty surgery center wanting to add additional surgeons and other specialties to try to leverage its cost structure, or you may have a situation where the physicians are tired of a large multi-specialty operation and are looking to have a smaller surgery center that really meets their needs a little bit more. Talked a little bit earlier about involvement of multiple types of market participants. You have multiple hospitals or health systems. You can have surgery center management companies, and then you have independent physicians themselves. Other driving factors, really access to capital. We've seen some surgery centers that are really constrained in certain CON markets where it's complicated and costly to add additional operating rooms, and they might be in a situation where they're at a point where they need to add those additional operating rooms. They may evaluate bringing in a third party, say a ASC management company or a health system to help achieve that. Other markets we've seen smaller surgery centers have a hard time contracting with payers, and they're not out of network by choice, but rather they haven't been able to secure contracts with payers, and they're looking to position themselves to be able to gain those contracts and work with a ASC management company or a hospital or health system that has the expertise to negotiate contracts. Here, looking at some of the driving forces behind the contribution of hospital outpatient department surgery center, and this is an area where we've really seen a large uptick in some of the recent transactions that we've been involved with. You can see a hospital's position within a local market. They may be the second or third hospital in the market in terms of size and perceived quality. They may be in a position where they have declining case volumes in their existing HOPD. They're having a hard time employing physicians, and they're losing cases. because some of the other hospitals are outpacing them with the growth of their medical groups. They may want to also engage an experienced management company to come in and help them manage and run the surgery center. All of these things really lead to a hospital considering contributing its HOPD to a joint venture and bringing in physician investors, ASC management companies, other types of investors to come help run the surgery center. And there's a recognition of possible payment neutrality. They may have an existing HOPD that isn't subject to lower payment as of this time, but it may be a situation where there's recognition that going to a freestanding ASC and receiving lower reimbursement may be beneficial for the hospital. They'd rather take that lower reimbursement but have quite a few more cases and share really in that greater profit rather than have a sinking ship with their current HOPD. It ends up being a little bit less costly physician alignment opportunity. They can ensure that some of the independent surgeons remain independent in the area. They can align from that sense versus having to go out and acquire a ton of medical groups and things of that nature. And there's always other local environment factors that impact these sorts of decisions. So here, really going over the valuation overview and fair market value considerations. It's important to note that not all of the valuation approaches are applicable in each one of those joint venture opportunities that were outlined in the previous slide. But we'll go over each approach, and then we'll show a couple of examples in some of these later slides here. So with an income approach, you have a single period versus a multi-period model. Under a single period model, that would be for a fairly stable surgery center that doesn't have much in the way of substantial abnormal growth in cases or expenses on a go-forward basis. In a multi-period model, you may have periods of abnormal growth that need to be captured or greater than normal growth that need to be captured, or declines for that matter, if we're seeing decreases in cases because of, say, an orthopedic group decided to sell its interest and align with another health system. Under the market approach, you have the guideline public companies that are publicly traded. There's 3 ASC management companies that one could look towards. There's also greater healthcare services companies that you could look towards for guidance as to kind of the direction of valuation multiples over a period of time. And then you have comparable transactions. There's transaction databases out there that outline several different transactions that have occurred across the country in the ambulatory surgery center space. You also have surveys and other sources of information that can be used in a similar fashion as comparable transactions. Then lastly, you have an asset approach or a net asset method. Here you're essentially looking at the assets that are on the balance sheet. You may be adjusting some of the assets to fair market value and determining the value of the surgery center in that fashion. It's important to note that the asset approach is commonly used for de novo surgery centers where you're evaluating essentially the capital contributed to be able to get the surgery center up and running. For a de novo surgery center, you're likely not to use a market approach. Wouldn't be applicable. You don't have any existing revenue or profitability to analyze. And then an income approach typically is going to be used for an existing surgery center. I like to also use an income approach when looking at de novo surgery centers, so I can at least see what the pro forma looks like and understand what the rates of return look like, recognizing that it's going to be a fairly high rate of return. Surgery center's not yet up and running, and there aren't any established case volume or revenues that have been earned or achieved historically. And then the market approach is going to be for existing surgery centers that are being valued. And then in looking at these joint ventures, you have to also use an asset approach after you've valued what's being contributed to make sure that each side understands what they're being contributed and what is being contributed by each party and what the respective ownership percentages are going to be. If one party is contributing a surgery center that's worth $5 million and you want the ownership to be even, 50%, 50%, the other market participant has to contribute something that's worth $5 million. Typically, it's going to be cash. In certain instances where we're looking at capital improvements, it may be funding those capital improvements up to $5 million. Thereafter, capital improvements would be split 50-50. Sometimes it could be buildings, services. Seen a lot of different creative ways of evaluating some of those joint ventures. Here, taking a look at continued fair market value considerations, we're looking at the guideline public companies and what they're trading at as of today on a trailing 12-month enterprise EBITDA multiple basis. You can see that the three publicly traded surgery center management companies are fairly closely aligned. You have AmSurg and Surgery Partners both trading a little bit above 9 times EBITDA, with Surgical Care Affiliate trading close to 11 times EBITDA. It's important to consider when you're valuing a surgery center, you want to understand what the market looks like for surgery centers, and one way of understanding that market is evaluating these public companies. Not suggesting to use the guideline public company method as a approach by itself, but it's at least a test of reasonableness. These are obviously very large companies that have certain geographic diversification and ownership in hundreds of surgery centers across the country, and access to capital that a single surgery center wouldn't have. But it's at least important to note what these companies are trading at to try to make sense of, say, an income approach or a comparable transaction method that's being used to value a subject surgery center. And it's also interesting when folks misapply the market approach or don't understand the results of a market approach. And that's a little bit on a later slide, but getting into that, there's assumptions within each one of these valuation multiples, and you have to understand what the pro forma, what the historical results as well as what the pro forma results look like for each company, so you can understand whether, say, a normal, quote-unquote, normal valuation multiple is applicable, or whether certain changes are occurring within the surgery center that may lead the multiple to appear abnormally low or abnormally high in a situation where you have substantial declines in case volume and profitability within a surgery center. On a trailing 12-month basis, you may see a valuation multiple look incredibly low, but if you look forward on a say an average projected 3-year EBITDA basis, you may see a multiple that makes a little bit more sense. And the same is true of the opposite scenario, where you have a surgery center experiencing substantial growth in both cases and profitability. You may see the opposite happen, where the multiple on a trailing 12-month figure may seem incredibly high. You may see a surgery center with a 12 or 13 times multiple, but when you look at that multiple over the projected 3 years going forward, it may trend back towards more a normal level. Looking at fair market value considerations, one way to look at comparable transactions, we put out an annual survey here at Healthcare Appraisers that surveys the marketplace, and we try to understand where deals are getting done. There's been an expansion in valuation multiples over the last several years here, from 2013 to 2016. You can see the vast majority of respondents in 2016 indicated that controlling interest multi-specialty ASCs are transactions are being conducted somewhere in the 7 to 8 times range. There's a lot of assumptions obviously used within a survey, and it's not going to capture every single scenario. There's going to be scenarios where that multiple should be quite a bit lower than that 7 to 8 times, and scenarios where it should be quite a bit higher, but it's at least good from a kind of a sanity check standpoint to consider these sorts of surveys, such as the one that we've put out, as well as other comparable transaction data that you gather from the Capital IQ or Irving Levin or one of the other databases out there. Here, looking at some of the common errors and pitfalls in the fair market value analyses for joint ventures, and particularly focusing on HOPDs that are being contributed to a new entity. Forgetting to normalize revenue using an inflated revenue figure that's based on a different fee schedule. That's an area where one's going to overvalue the surgery center that's being contributed. I should say the surgery center operations. Not fully accounting for all of the appropriate expenses. Quite a few times when you receive an HOPD surgery center income statement, it may be more of a direct cost basis. You may essentially have contribution margin being represented, all the fixed costs, real estate costs, and other overhead costs may not be allocated down to the center. It really depends on the hospital that you're working with and whether that's an exercise that they've done historically or one that you're going to have to go through together with them to make sure you fully burden the surgery center. And then a couple of items that folks forget about, management, billing and collecting, and other support costs will need to be passed through if the joint venture surgery center is going to rely on the hospital to provide certain management services, certain billing and collecting services. We have to make sure that we don't forget to allocate those costs to the center, whether it's a contribution of an existing HOPD or whether it's a de novo center. And then supplies costs are important as well. When somebody's projecting out a surgery center, they'll regularly forget to analyze supply costs at the case level basis. If you're adding additional cases or you have abnormal growth associated with one of the specialties, the orthopedics is an example, which tends to have a high degree of supply costs, there's going to be either an over, under projected supplies expense in the valuation model. The use of valuation approaches, we've seen several scenarios where a valuation firm that's not familiar with either the healthcare space or not familiar with dealing with joint ventures may use some of the wrong valuation approaches, or they may use the approaches in such a way that the result isn't fair market value, it's something more in line with investment value or strategic value. The assessment of risk associated with the projected cash flows. We've seen certain valuation firms forget to really assess this risk and understand what the risk is associated with achieving these projected cases and some of the projected cash flows. Then the opposite is true as well. We've seen some firms that are overly draconian and think the sky is falling and will assess a very high discount rate when present valuing the cash flows under an income approach. The level of value is important. We see errors in this part of valuation all the time where one may forget to consider discounts for lack of control or lack of marketability. These discounts certainly have to be considered when existing surgery center operations are being contributed to joint ventures. Maybe a situation whereby a portion of a surgery center is being contributed, or you have a scenario if the whole surgery center is being contributed, there needs to be a secondary discount after the 100% value is contributed. One party may not be able to buy in at 50%. They may be buying in at only 30% or a minority interest in this joint venture. We have to make sure that those secondary discounts are accounted for. And then adjusting for a stock versus an asset deal in a scenario where an HOPD is being contributed, it's going to be an asset deal. Need to make sure that all of the correct assets are accounted for, as well as any liabilities that may be assumed if the assets happen to have any liabilities associated with them or any other encumbrances. And I ended up getting done a few minutes early here, so happy to take any questions. Appreciate everybody taking time to listen to the presentation.
Thank you to Mr. Jeniga for a very informative and enjoyable presentation. We will now begin the question and answer portion of the program. As a reminder, you can submit any questions you have by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our presenter will attempt to answer as many questions as he can during the time we have for a Q&A. So to get us started here, Mr. Jeniga, what are the trends around out-of-network ASC valuations? It seems like there are a lot of price and legal pressures put upon them. What is the expected future for these type of centers?
Yeah, absolutely. I mentioned a scenario where we valued a surgery center, and it wasn't purposely out of network. It was a situation where the surgery center had a hard time gaining contracts, so that's why they were seeking a partner to work with. In other scenarios, there's certainly out-of-network strategies that are still being employed by certain market participants in certain geographic areas. We've seen scenarios whereby going in network really isn't as painful as it may seem. There can be an increase in the number of cases that are referred to the surgery center, given that there's less pressures of going in network. There can be easier collections. Sometimes the collections issues are becoming a problem with the insurance companies fighting back and sending some of these payments directly to the patients or denying claims, making life really difficult on these out-of-network centers. So I think we still see activity here. There's a couple of out-of-network strategies where one may be getting new provider numbers every few years and trying to really work around the system, but otherwise we see folks working to go in network or considering partnership. And our ASC survey suggests that folks are trying to put together pro formas whereby folks are analyzing what the in-network economics look like and trying to price the interest in the surgery center in that way. That's what we focus on under a market approach. We'll consider possibly a lower market multiple given the risk associated with going in network.
Thank you, Nick. And the second question we have here is, are you seeing an uptick in merger activity between freestanding ASCs in which one surgery center buys a controlling interest in another surgery center and rolling up under one tax ID?
We have seen certain activity where surgery centers are coming together in different markets. We've seen some examples where a primarily orthopedic surgery center may fold in a pain management surgery center. We've seen some other scenarios where a group of independent physicians have decided to join forces, and they'll bring some of their ancillaries together, such as surgery centers. We've seen an uptick in that in recent years, but it's going to be market specific and really down even to the local level, whether there's physicians that are wanting to work with one another.
Okay, thank you, Nick. The next question we have here is, what type of returns are needed to justify a joint venture ASC for surgeons considering an equity investment? I've heard of most developers require a 30% return. Is that what you've seen?
That's fairly specific. I would have a hard time directly answering that question. I guess my answer, unfortunately, is it depends. It really depends on the individual investment opportunity and what's available in the marketplace. It could be a situation where the de novo center is very risky. It could be another situation where the de novo center isn't very risky. It really depends. So I can't give a blanket answer that would comment on the 30% that the person asking the question referenced.
Okay, thank you, Nick. And how are you analyzing the contribution of the fixed assets in their overall value of the facilities or businesses?
When appropriate, we have a fixed asset team, and we'll get them involved to either do a desktop appraisal whereby they're valuing the furniture, fixture, and equipment based on a list that's been provided to them, as well as some supplemental data points, invoices, and maybe some pictures of the higher dollar assets, or they go on site and actually inventory everything. That certainly can play into the asset approach, as well as any sort of purchase price allocation, to the extent that a party wants to understand how much of the value is attributable to tangible assets versus intangible assets, whether they're identifiable or just goodwill.
All right, thank you. And another audience member is wondering, can a freestanding ASC be valued differently if a hospital system is buying in versus if individual physicians are buying in? That is, are there stark and anti-kickback implications if shares are valued higher for hospital systems versus individual physicians?
I probably shouldn't answer that question. I'm not an attorney. I think the person asking the question should reach out to a local healthcare attorney and get some legal guidance on that. I'd be happy to, if the person asking the question wants to follow up with me, I'd be happy to point them towards a couple of good healthcare attorneys that I've worked with in the past that would be able to help out there.
Okay, thank you, Nick. All right, and how do you account for the revenue variance when HOPDs are converted to ASCs? Do you value based on ASC market rates? And if you do not have the ASC market, how could you estimate revenue potential?
So we try to estimate the ASC market rates. We have quite a bit of data that we're able to rely on in-house from valuing previous surgery centers across several markets. And in other situations, we are working with market participants to understand what the most likely scenario is, trying to understand. We start off with some reference points, say Medicare rates, and understanding what the premium is on that some of the commercial payers are offering relative to Medicare. So we'll just try to go forward with our best estimates in that scenario, but we definitely consult with data points that we have in-house, or consult with market participants that we're able to work with and have them help us get our hands on some data points.
Thank you, Nick. Okay, our next question we have here is, do you see any differences between the way one values an ASC as compared to a micro hospital or a small specialty hospital?
There can be some differences. I think from an approach standpoint, we're likely going to focus on both an income approach as well as a market approach. For some of the micro hospitals, assuming that they were in place prior to the enactment date or the extended date associated with Section 6001 of the Affordable Care Act, they're able to then see Medicare and other governmental payer patients. Those are incredibly valuable assets. There's a limited number of them available in the marketplace. There's limitations on how they can expand in terms of beds and operating rooms, but they're very valuable assets. Any further development in that space has been around just commercial patients, and there's obviously limitations there when you're not able to serve a large percentage of the population. So in those cases under a market approach, we're digging fairly deep to try to find comparable transactions of these hospitals, and we have several in-house that we've relied on in the past. And we're also running an income approach and considering some of the rate of return assumptions, and those assets do tend to have a premium relative to a surgery center.
Thank you, Nick. And in your experience, have you seen transactions with employed groups? And if you do, how does the health system deal with physician compensation?
With employed groups, I'm not 100% sure I follow the question, but we've certainly seen in some markets where there may be a physician group that's still independent but may work with a particular hospital system through some sort of PSA, and they may still joint venture in a surgery center. So the compensation arrangements associated with those PSAs can vary widely depending on the market and the specialty, but we typically see some sort of dollar per RVU or percentage of collections type of model in place there.
Awesome. Thank you, Nick, so much. And the next question we have here from an audience member is, if an ASC is losing money, do you give any value to the intangible workforce that's already in place?
We may give consideration to intangible assets associated with an ASC that's losing money. It's not always going to be the workforce that's in place. It really is facts and circumstances specific, but we'll definitely take a look at other assets that may exist regardless of whether the surgery center is making money. That would be, say, a certificate of need if it's in a certificate of need state, licensure. There can be other specific trade name assets that are unique to the marketplace. Possibly from time to time we'd consider some of the workforce, although I wouldn't necessarily consider it to be an incredibly valuable asset in most circumstances.
Thank you, Nick. And one question we have here is pertaining to anesthesia relationships and costs. So how do you look at ASC's anesthesia costs in the relationship with anesthesia providers at the ASC?
Sorry, can you repeat that question one more time?
Yes, I will. The question is, how do you look at anesthesia costs in the relationship with anesthesia providers at the ASC?
I think the cost of anesthesia needs to be at fair market value, and that's one of the areas I touched on. Any sorts of services that are being provided, whether it's professional, such as anesthesia, or whether it's something administrative, such as management services. All of those need to really be at fair market value. There can be subsidies and things of that nature that the surgery center needs to pay if the anesthesia provider isn't able to generate enough professional fees to really support the service.
Thank you, Nick.
Yep, absolutely.
Oh, sorry, I didn't mean to cut you off there. Were you still going?
No, that's all right. That's good enough.
All right, well, thank you very much. And we have another attendee wondering, and have you seen, and if so, how often, a different buyout valuation price from the market buy-in price? How do you account for the left behind value, and where does it go, and what are the tax considerations? So there's a bundle there.
Okay. Quite a few questions rolled in there.
Do you want me to start with the first question?
Yeah.
Have you seen and how often a different buyout valuation price from the market buy-in price?
Possibly. It depends. Sometimes there's buy-sell agreements whereby it's some sort of standard formula that's applied for any sort of minority interest buy-in or buyout over a period of time, and there may be a change in value if a physician held an ownership interest for several years. It may not be material. The kind of the value proposition is more the distributions that the physician's been able to earn over a period of time. And then obviously if the ASC was to do a larger transaction, whether it's being contributed to a joint venture or whether it's selling out entirely, the buyout price would be vastly different there. There would be a valuation, fair market value valuation process that was considered by the parties and not a formula that was used like the buy-sell agreement.
Thank you, Nick. And another question we have.
In terms of the tax considerations, that's not something, I'm not a tax accountant or tax lawyer, so I'm not going to comment on the different tax impacts. I know there are tax impacts, but the person asking the question should consult with an advisor in that area.
Okay, great. And I think we're going to do one final question here before we wrap it up. What adjustments do you make for a cash basis accounting ASC? And do an adjustment to an accrual basis impact value, or is it more of a timing difference in collections that doesn't really impact the earnings?
It can be more of a timing impact as it pertains to the cash basis versus the accrual basis. If we see a situation where there's a large increase in revenue or a large decrease in revenue, that's where you're going to have some of your largest timing impacts, really on the accounts receivable side. Sometimes we'll normalize the financials, and other times we'll try to make other adjustments through the model. So it somewhat depends, I suppose.
Thank you very much. And with that final question, I want to again thank our presenter for his excellent presentation and for all of you for participating today. We look forward to having you join us for future webinars. This concludes today's program. Have a wonderful afternoon.